Good morning and welcome back to Almus Market Mornings. As we head into the weekend, one of the key thoughts in investors' minds would be geopolitics, and rightly so. In the past, we have observed things happening on holidays which disproportionately impact trading on Monday. The US Iran talks seem to be steady at this point. Mediators seem to say there has been significant progress on talks, which are set to continue into the next week. Oil prices and precious metals are steady at the present levels. But the kind of US military deployments in the Middle East currently and updates coming in, for example, the reduced staffing in the US Navy's Fifth Fleet headquarters in Bahrain, is keeping markets on the edge for a potential US strike. Good morning, JK. Give us some of that wisdom on managing this kind of geopolitical uncertainty.
Good morning, Swaraj. Uh, so I think the situation is still quite uncertain, uh, despite the positive statements from the mediators who have been around. And the talks obviously are set to continue next week. Mm, uh, I think there is also an indication that the House of Representatives will force a vote next week that will require Trump to seek congressional approval before a possible attack on Iran. So this means that it's not going to happen uh, so easily, an attack on Iran. At the same time, the strategists at US, they are thinking that the first attack, if any, should be made by Israel. So that supports US action. And that may go well with the voters. So it's politics and geopolitics combined that's working right now. But I think markets are now well prepared for what's likely attack. And yes, there could be knee-jerk reaction if there is an attack, but unless it situation escalates too high, uh, I think markets may not see it very seriously, and quick resolution will always lead to rally in the market. So market is currently positioned for that, be it rupee or oil or even the precious metals, even the bonds have been bought. Despite the fact that US data has been better, yesterday jobless claims also came lower. You would have probably expected the yields to rise, but yields are actually breaking 4% on the 10-year. So the point I'm making is that the market is well prepared for an attack on Iran by the US, and that if the talks fail. However, probabilities are that the action may not happen, or uh, even if it does happen, the post-action reaction in the market may be much less than what is being anticipated. So we will continue to watch the market developments and the statements. As you said, weekends are very dicey always, and they always come out with some sort of a new developments. So that's something that we definitely look out for. Yesterday, markets had very mixed performance, particularly in the US. Nvidia results were good, better than expected. But earnings report alone are not able to sustain the US markets, particularly on the tech sector, because the continued worries about AI sector investments, and also the disruption that it may cause to the existing tech sector. That is keeping the markets somewhat on the bearish side. So I think that has also led to some sort of a shift into the world economy stocks. Dow Jones was steady, while Nasdaq fell quite hard yesterday. The trend in Nasdaq is definitely on the bearish side. It looks like it can continue for quite some time. Not much of an economic data. But one interesting number which the market was looking at was the CPI number from Japan. So inflation came lower than the 2% that was seen last month, but it was higher than expected. But the ex-food or the core CPI rose to 1.8% versus 1.7% expected, and that kept the rate hike talk alive. In fact, there have been more statements from the Bank of Japan chief who continues to say that they will raise rates in line with the economic data, and possibly that the rift between the politicians and the financial sector managers are actually slightly widening, and that probably is keeping the yen in a range. Uh, Even other data like industrial production and retail sales in the Japanese economy also came better, so does not support a dovish or big and negative for the Japanese economy, so that we have to keep the rates lower. Japanese inflation if you take it 1.6% also, the the official rates is at 0.75%. So we are still very much deeply in the negative territory as far as the real rates is concerned. So it makes much more sense to expect a rate hike normally, unless the politicians have upper hand in this regard. Uh, for rupee yesterday, offshore market has seen once again 91 level being broken, and the very short term there is some pressure due to NDF market buying, but what I'm seeing is the seasonal factors and technical positioning can help it recover more than modestly in the month of March, barring any unexpected rally in the broad dollar. I think USD should move between 90 and 91.20 in the run up to the year end, with a slight vulnerability or actively on the strengthening side. As I mentioned yesterday, February happens to be the first month after 9 months of gains for the USD INR. That could see some sort of a corrective down move in the USD as well. Meanwhile, forward premiums have also inched up nearly 10 basis points this week alone, which once again is due to seasonal factors as we near the financial year end, renewed outflows in FX, and the anticipated tax outflows in March as well. So this could be a deterrent for forward import covering, and is actually an attractive proposition for exporters, as the spot rates very much not too far from the all-time highs as well. Another good news for India is that the FPI flows in February at 4 billion, 4.2 billion in fact, is the highest in 17 months. Although the local mutual funds have been sellers after being consistent buyers. So the flow wise, I think situation is slightly improving. The rupee is closer to not too far away from the all-time highs. Forward premiums are higher, and seasonal factors favor the rupee. So all in all, I think the rupee, after maybe the geopolitical air is cleared, can have some sort of a traction on the upside for the rupee, and that of course be not too much unless the flows take a bigger turn. Thank you.
Thank you, JK. And yep, so geopolitics will keep an eye out for that going into this weekend. But otherwise, when it comes to the rupee, we do have some sort of a weakening bias in the short term. But the seasonal factors, it should help rupee remain in a range. And some of the structural factors which were impacting rupee, like flows, that seems to be improving because February helped bring in significant amount of foreign money. So when actually the tide turns, it should help rupee strengthen significantly. Otherwise, when we look at the other narratives, the AI disruption narrative, which we have discussed the entire week, that seems to still bear on the tech stocks, industrials doing relatively better, and the geopolitical uncertainty keeping oil and gold elevated but steady at higher levels. Bonds also seem to be bought because yields are quite subdued. So we'll track all of these narratives next week as well. We'll keep you updated with the latest updates from the financial markets. Thanks for listening. Have a great weekend.